Hello, my dear students. Welcome to another objective series session under the RBI mentorship program of 2024. So today we will see one of the we will analyze one of the current affairs topic related to the forex reserve and the swap option. All right. So what appeared in the news in the month of March only, in the month of March 2024, what has appeared in the news that in April 2022, RBI has conducted a $5 billion sale by swap. All right, in order to elongate what maturity profile of its forward book and smoothen the receivables related to the forward assets. What happened in the post-COVID? After the COVID crisis, Government of India as well as the Reserve Bank of the country, it pumps lots of money, huge amount of money into the market in order to stabilize the market because there were financial crunch were being felt by the general public. So and Government of India has to also expend in the expenditure part in its expenditure part for the socio-economic welfare of the person. So it pumps lots of money for the various developmental projects. All right. So because of this, the market felt the influx of around 5 trillion rupees. It felt the influx of 5 trillion rupees. But what is the impact? If a market is liquidated with lots of money, then what will ultimately happen? It will lead to increase of inflationary pressure. Lots of money is there in the market. Along, however, there are limited products in the market. So somewhere it is leading to the inflationary pressure over the market. So, in order to reduce this, RBI has conducted a swap agreement with the market players, all right, with the banks and the financial institutions. So, let's understand the swap agreement and what about the delivery of swap means. All right. So, let's see that this is RBI and there is huge money has been already been rolling out into the market, that is with the banks or the financial institutions. So under the swap agreement, what RBI does that it tries to pull out the excess money available into the market. All right, it tries to pull out excess rupee available in the market, and in return, in exchange of these rupee, it gives the same value of dollar to the banks. All right, or the financial institution. So in the swap agreement, pulling out of Indian rupee happens. However, the delivery of dollar took place. Means exchange of dollar with the rupee in the swap agreement. After the maturity, RBI has some options. In this case, the maturity uh, came on 11th of March 2024. So on this date, RBI has certain options. What are the options held with the RBI? That it has three options, that either it will take the rollout, it will go to the rollout mechanism. All right. It will go on to the rollover of the swap agreement, or rollover or rollout, you can say, or it will take the delivery, or it will took the partial delivery. Partial delivery means after the maturity, either RBI will cancel the swap agreement. Means RBI will say, no, I am not going to liquidate again the market with the rupee. Let it be. I am canceling the swap right now, or I will moving the swap to later date. All right. It is again making an agreement with the market, and it will extend the swap. Or after the maturity, it will take the delivery. What is this delivery means? Let's see, after the maturity, what RBI is going to do. RBI took the delivery, means here's the bank or the financial institutions. All right. Now RBI is doing what? That it is again pulling these dollars that it has pumped the $5 billion from the market. Okay, it is sucking out the $5 billion from the market, and in return, it is pumping the rupee of same value to the market in order to liquidate the market. All right. So in this news, what RBI has done on the maturity, it has not gone to the rollover option. Rather, it took the entire delivery. So this mechanism is called delivery delivery of swaps. All right. Whatever swap has happened over here, RBI took the delivery. Means it suck out all the $5 billion from the market, and in exchange of what? It pumps the same amount of rupee to the Indian financial system. All right. Am I clear with the concept? And the last option held with the RBI is partial delivery. Means, suppose let's see that out of $5 billion, if it will take like delivery of only $3 billion, and hold the delivery for remaining $2 billion for future date. So RBI, in this case, RBI took the delivery of entire amount. All right. So by understanding the concept about the swaps and delivery, let's see the question. Let's try to solve some questions related with these agreements. All right. The first question: what does delivery of swap means in the above paragraph? What does the delivery of? I've already discussed that pulling up of dollar from the market in exchange of rupee. So option 2 is the right answer. Means here RBI is going to pull up the dollar held with the market financial system, and in exchange of rupee, it is pumping out rupee into the market. Second question: what will be the impact of taking delivery of swaps on the forex reserve held with RBI? What will be the impact? Let's see. It is pulling out the dollar from the market. Means the forex is going to increase now. Forex with held with the RBI would increase after taking the delivery. So forex will increase held with the RBI. All right, held with RBI. Let's see the third option, the third question over here. What will be the impact of this delivery on Indian market? अब इंडिया का मार्केट को क्या इम्पैक्ट होगा? RBI took the delivery. Indian market is influxed with fresh amount of money, fresh amount of rupee. And why? Uh, Let me ask you one question. Why RBI has took the delivery? What is the reason behind taking the delivery in month of March only? There might be some reason. See, there are two reasons. Basically, right? Basically, there were two reasons in this case, that advance return means advance income tax. People are filing their advance IT returns by 15th of March. Okay, this will lead to what? This will lead to like decreasing the money held with the people. Means it is somewhere it is pulling out the rupee from the market, from the people. All right, through these advanced IT returns. And by 20th of March, the corporates need to file their GST returns, 3B returns. Okay, GST 3B return means corporates have to pay an enormous amount of tax to the government of India. All right. So by these two, because of these two returns, direct or indirect tax returns, the money in the market reduces. The money, the liquidation of rupee in the market actually reduces. So in order to tackle this situation, RBI took the delivery so that more and more money can be influxed into the market in order to stabilize, in order to keep the economy run smoother. All right. So, this is the reason. This is the prime reason behind the taking up of delivery of the entire $5 billion by the RBI. So, what is the impact of this delivery on the Indian market? So, how it is going to impact? The positive impact or negative impact? See, the paying capacity of individual will increase. Obviously, when the market will be influxed with fresh amount of currencies, fresh amount of rupee, then the banks or the financial institutions have more money in order to lend to their customers, in order to lend to the other corporate houses or other people. All right. So by this, the paying capacity of the individual will increase. So this one is the right answer. The saving in the bank will increase. No, it is not going to increase the saving of the bank. All right. Directly means immediately, it is not going to increase the saving in the banks. Inflation problem can be handled. This is not going to solve the inflation problem. All right. So we can cancel the option over here. And the interest rate of lending will further increase. No, the interest, since there is huge money in the with the financial system, with the financial intermediaries, so the interest rate will obviously decrease. It is not going to increase. So the correct option over here is option number one, that is paying capacity of the individual will increase after taking out the delivery. Let's see the question number four over here. It is about the SDR, the forex reserve. All right, it is about the forex reserve and its component. SDR is neither a currency nor a claim on IMF. It is neither a currency, rather it is a bucket of currencies. All right. It has a potential claim on the freely usable currencies of IMF members. Okay. SDR can be exchanged for these currencies. The SDR serves as the unit of account, and I have given some information about the SDR. SDR serves as a unit of account of the IMF and some other international organizations. The currency value of SDR is determined by summing the value in US dollars based on the market exchange rate. Okay, so the value of SDR is determined by what? By summing of the US dollar based on the exchange rate prevailed in the market of the SDR bucket currencies. IMF uses the basket of currencies to determine SDR values, and the weightage given to those basket of currencies vary as per its prominence in the international trades. So there are different currencies. You know about the currencies in the SDR buckets. So their values, the value of these currencies were determined by the international trades. All right. And in this respect, the question has been drafted that what is the correct order of weightage of currencies into the SDR. All right, you need to identify what is the correct order of weightage of currencies. So weightage has been given to different currencies like USD. It is like more than 41% weightage has been allocated to US dollars. After that, Euro, around 38% of weightage has been allocated to Euros. So you need to identify which is the correct option from increasing to decreasing order regarding the weightage provided to these currencies. So tell me the correct option. Option D is the right answer. USD dollar. USD dollar has got the maximum weightage. After the euro is there. After that, the Chinese renminbi is there. Then the yen, Japanese yen is there. And the last one is pound, means British pound, pound sterling. All right. So this is about the question number four. The you need to remember the correct order. USD is the first. The weightage for USD is most. After that, euro. All right. After that, Chinese currency. After that, yen, and lastly, the British pound has been given the less weightage. Let's see. Let's move on to the question number five. What is the significance of rising forex reserve? What is the significance of rising the forex reserve? Uh, let's see the question over here. The statements given in the question. What are significance? The first statement, it helps the government and the RBI in managing the India's external and internal financial issues. So if RBI has more and surplus of forex reserve, then is it going to help the government and the RBI in managing its external and internal financial issues? Yes, it is going to help out the government and RBI. All right. See the second statement, it serves as a cushion, means buffer like thing, in order to see the in order to tackle the balance of payment crisis. Yes, definitely, forex reserve is high. It will serve as a cushion in order to tackle the BOP crisis. Third, the rising reserves have also helped the rising reserves have also helped the rupee to strengthen against the dollar. If the forex reserve will increase, means the Indian rupee will appreciate. It will strengthen against the dollar. So this option is also correct. Reserve will provide a level of confidence to market and investors. See, the rupee is appreciating. We have more and more reserves in order to settle down our international trades. So it is going to boost up the confidence into the market as well as investors, and it will attract more and more foreign investors as well as internal local investors as well. Let's see the fifth statement: supporting and maintaining confidence in the policies of monetary policies and the exchange rate management. Yes, obviously, it will support the monetary or the fiscal policy in order to frame the monetary. So by this, all the statements were correct. All right, all the statements are correct for question number 5. Let's see the last question of this objective series session. It is also about the forex reserve. Forex are the reserves assets. I have given the information about the forex reserve over here. Are the reserve assets held by central bank in foreign currencies. They may include foreign currencies, bonds, treasury bills, and other government securities. Reserves are dominated and expressed in US dollar, which is international denominator for the purpose. RBI is the custodian of forex reserve in India. Remember this point. Who is the custodian? RBI is custodian of forex reserve. India's forex reserve stood at $625.6 billion on 1st of March 2024. So this is one fact that it has crossed the mark of $600 billion. And this figure will obviously change as the exam of your RBI came nearer. We will update it in for your examination purpose. But right now, just remember it that on 1st of March, the forex reserve held with India with is around $625 billion, $0.6 billion. India's foreign currency reserve comprises of what? It comprises of foreign currency assets. It comprises of foreign currency assets. The second thing it comprises of gold reserves. The third one is SDR. We have discussed about the SDR was in fourth number question, and the fourth one is reserve range position. All right. So these were the determinants. These were the components under the forex reserves. In respect of the amount of India's forex reserve held by different components, these four components, you need to identify the correct order. Means under which head maximum reserve has been put up. In FCA, in foreign currency assets, or on SDR or gold or RTP. You need to identify the correct order. So the right answer over here is option number D, means maximum reserve is because of the foreign currency assets. After that, the gold reserves, then the SDR, and finally the RTP, reserve trade. We have already discussed about the forex, about the balance of payment prices, about the concept behind the balance of payment, the current account deficits, the capital account deficits and surplus. We have already discussed over lots of things about the forex, about the concept, about the delivery swaps in our current affairs sessions for the month of March only, and in our static portion. Here, what we are trying to do in this mentorship program, we are actually trying to connect your static portion with the current affairs. All right. And we are trying to frame applied questions that can appear in your upcoming examination. So we are trying to frame applied questions with some static news and with lots of current affairs. So I hope you will enjoy these. You are enjoying these sessions. I just want everyone to uh, keep keep your eyes open for these sessions and be connected with us. Thank you very much from C4S platform.